All right, let's jump right in and talk about something that affects absolutely all of us. What happens the exact second money hits your bank account? If you've ever looked at your balance at the end of the month and felt like your cash just, vanished into thin air, trust me, you are definitely not alone. So today, we're doing an explainer on some incredibly powerful financial strategies, and we're breaking down the 2026 paycheck routine. We're actually going to treat this like a 5-step gamified playbook. So let's dive into this and completely level up your financial life. $10,000. Yeah, take a second to let that number sink in. What is truly staggering here is how easily that amount of money just disappears without us even realizing it. The source material breaks it down perfectly. A $5 morning coffee, maybe a $15 food truck lunch, a couple bucks for transit, a little sweet treat in the afternoon, and let's say $140 a month on subscriptions you totally forgot about. Bam! That adds up to 10 grand leaking right out of your pocket every single year. It's the quiet, everyday reality of living without a rock-solid paycheck routine. So, to plug that massive leak, here is our 5-step paycheck playbook. 1. The financial baseline. 2. The safety net. 3. Killing the debt parasite. 4. Autopilot wealth. And 5. The fast lane. Here is the immediate, non-negotiable action plan for the very minute that new paycheck drops. You separate your wants from your needs, build up a 3 to 6 month safety net, ruthlessly go after high-interest debt, heavily invest in index funds, and then, if you've got the stomach for it, fund side hustles in crypto. It's a strict sequence. You can't just skip ahead to step 4 without conquering step 1 first.
So let's start at level 1, the financial baseline, separating needs from wants.
Okay, this is where the really tough work actually starts. The source recommends pulling about 6 months of bank statements to honestly, truly confront your spending habits. You literally split a page into 2 columns, needs on one side, wants on the other. But here is the ruthless rule you've got to apply. If you can physically survive without it, it goes in the wants column. Rent, insurance, basic groceries, needs, obviously. Restaurants, golf, streaming services, absolutely wants. This exercise is so critical because those tiny everyday comforts are exactly what quietly rob you of your long-term financial freedom.
The ultimate goal for 2026 is to actually shrink your needs down to just 25% of your total income. Now, I know what you're probably thinking. In today's economy, getting rent and bills down to 25% feels almost completely impossible. And the source material completely acknowledges this hurdle. If your bills absolutely won't budge, you either need to make a drastic change, like moving to a cheaper area, or you have to increase your income by snagging a promotion or launching a side hustle. Because honestly, your earning potential is always going to be higher than your saving potential. Keep your wants capped at another 25%, and suddenly, you've freed up a massive 50% of your paycheck for the next levels.
Which brings us right to level 2, the safety net, shielding your finances.
With that freed up cash, 20% of your total paycheck needs to be directed here, following some incredibly strict rules. First, put it in a high-interest savings account, which is yielding around 4% right now, depending on where you look. Second, keep it at a completely separate bank from your everyday checking account. Out of sight, out of mind, right? Removes the temptation. Third, you're targeting 3 to 6 months of that baseline needs figure we just calculated. And lastly, never ever lock this money away in a fixed-term account. This is a lifeline for genuine disasters, like a medical emergency or your car blowing a transmission. It is not a fund for a weekend night out. It has to be instantly accessible.
Once that safety net is fully funded, we hit level 3, killing the debt parasite, the guaranteed return. To really grasp the urgency here, our source uses an amazing, vivid metaphor. They say having high-interest consumer debt is kind of like asking a doctor for the best diet advice while knowingly having a parasite inside your body. The doctor doesn't care about your diet right then. The priority is killing the parasite. I mean, why in the world would you invest in stocks hoping for an 8 or 10% return when a credit card company is actively draining you for 20 to 25%? Paying off high-interest debt is literally the only guaranteed high return on investment you will ever find. So how exactly are we attacking this debt? The source breaks down a showdown between 2 major strategies, the Avalanche method and the snowball method. Now, the snowball method is super psychological. You pay off the smallest balances first to get those quick, feel-good wins. But look at the actual data. The Avalanche method, which is the purely logical approach of attacking the highest interest rate first, absolutely crushes it. It shaves 2 entire months off your debt-free timeline and saves you over $1,000 in total interest. When it comes to debt, pure math beats psychology every single time. Parasite dead, safety net full. Now you unlock level 4, autopilot wealth, the 35 to 40% growth strategy. Taxes are always going to take a bite out of your money, but you can legally shield your wealth using tax-advantaged accounts. Think a stocks and shares ISA if you're in the UK, or a Roth IRA in the US. You are directing a massive 35 to 40% of your paycheck here. The strategy is brilliantly simple. Focus on low-cost index funds, specifically tracking the S&P 500. Pick an accumulation fund, which just means your dividends automatically buy you more shares. And above all else, set this entire thing on autopilot. Automatic daily or monthly deposits remove all the human friction. Basically, it forces you to get out of your own way. Let's actually look at how this plays out with a really cool anecdote from the explainer's source material. They call it the 5-pound coffee experiment. The speaker's son automated a tiny investment of just 5 pounds a day, literally the cost of a coffee, straight into the S&P 500. After 1 year, he had invested 1,503 pounds, but the value of the account sat at 1,707 pounds. That is a 13.68% return in just 12 months, achieved with literal pocket change, entirely on autopilot, and totally forgotten about until he checked the balance. Now, take that exact mindset and stretch it out to see the completely staggering power of compound interest. It's like a giant snowball rolling down a hill. If you automate an investment of just $250 a month into an index fund, returning a historical average of 8%, year one doesn't look like much, right? Just $3,000. But if you just leave it alone, by year 20, it balloons to $147,000. Give it 45 years, and that exact same $250 a month snowballs into $1.3 million, all tax-free. It's a slow strategy, but historically, it is incredibly successful. And finally, for those eager to speed up the whole timeline, we enter level 5, the fast lane. High risk, high reward. We are taking that final 5 to 10% of your paycheck for this stage. Now, you might be wondering, is 5% really enough to start a business? Well, the source argues a super fascinating point here. Having really tight financial constraints is actually a superpower. When you have less capital to play with, you are forced to become infinitely more creative. It literally forces you to find tiny, innovative gaps in the market that people with massive budgets completely overlook. And for the very last piece of the puzzle, the source outlines the absolute riskiest play of them all, cryptocurrency. They are very neutral on this, but the rules are incredibly strict. You allocate up to a maximum of 5% of your portfolio here, focusing only on major assets like Bitcoin and Ethereum. But the absolute crucial takeaway is your mindset. While there might be long-term potential, you absolutely have to treat this as a high-risk gamble. You need to be completely 100% mentally prepared for the value of this specific allocation to go straight to zero without warning. And that brings us to the end of our financial framework. We've covered shrinking your baseline, building that crucial shield, killing the debt parasite, automating your wealth, and navigating the fast lane. But look, information without execution is honestly just entertainment. So I want to leave you with a question to really chew on today. What is the very first move you are going to make the exact second your next paycheck drops? Are you going to let that money quietly leak away? Are you ready to execute the playbook? Thanks so much for hanging out with me on this explainer, and I can't wait to dive into our next topic with you.